10 years bond yields are spiking. What does this mean? It means it's showtime. So you know how the Fed has been hiking interest rates to suck liquidity out of the system and reduce inflation, right? The mechanism of this is that investors see the high interest rates and they move their money into bonds while avoiding taking on new debt, avoiding risky assets e.g. stocks, real estate, etc. This effectively deleverages the economy. But over the last year of rate hikes, for whatever reason, the investors simply didn't believe the interest rates would actually stay high. Jay Powell kept saying rates would be higher for longer, and analysts kept hearing rate cuts by year's end that led to this crazy yield curve inversion we've been seeing, where the long-term interest rates are significantly lower than the short-term interest rates. This meant that, even though rates were hiking, we weren't really feeling it that much. Yeah, we're all getting 5 in our high-yield savings accounts now. But long-term debt, e.g. 30 years mortgages, 84-month car loans, was still relatively cheap. Well, that's all changing now. The investors have finally woken up to the reality that Jay Powell is serious about keeping rates high, not just tongue-in-cheek serious. So now even the long-term bonds are only being bought at higher yields. The long-term bond yields are rising to catch up with the short-term bond yields, effectively uninverting the yield curve. And this brings us to our final destination of sucking liquidity out of the system if you can lock in 5 free returns for 10 years. Why would you keep your money tied up in a rental property that's only cash flowing 3.5? Is it even still worth it to have your money in the risk-prone stock market just to get a few extra returns? No. You're going to cash out and buy risk-free bonds like a financially savvy boomer. Shit's gonna start selling fast. This is the moment we've all been waiting for. The impact of the rate hikes is finally hitting, unleashing its true power. You might notice that the yield curve tends to rapidly uninvert immediately 3-6 months before every recession. This is what the curve looked like in October 2000. And by March 2001, the dot-com bubble popped. It was a similar story at the end of 2007. So which will be the first domino to fall this time? Nobody knows for sure. But commercial real estate is on its deathbed. Residential real estate is still overinflated. And banks are holding a ton of old lower-yielding bonds that are pretty worthless right now. I'd expect the housing market to correct, along with more SVB-style bank collapses soon. Don't fight the Fed. In Jay Powell, we trust. It means my pension fund has been taking a severe beating for the past year and a half. All I know is Buffet says yields are like gravity to stocks. The higher yields are, the lower stocks go. Invest all you can in your 401k. They said, it's free money and it doubles every 8 years. Fucking boomers caught a break on everything. The T10Y3M is still negative with the US 6-month at the highest rate. Jay Powell isn't done wrecking shop. VIX is poking above 18 here in Monday's pre-market and the JPM options collar has been rolled down. With labor's rise and WFH now a thing, these all are downward pressures on just about everything. Those that have real wealth will be fine. For everyone else, may the odds forever be in our favor. This guy is right, but we'll make no money off it. So you want to get out of equities and into bonds? People buying and bidding up the longer duration bonds would cause their interest rate to fall, not rise. Once there is any indication the rate increases have stopped and that rates may fall, funds with long-term liabilities will move into the long-duration bonds to lock in the current high rates. TLT is the trade to take advantage of this over the next 6-18 months. The government can't keep rates high forever. It makes their own debt more expensive. But why male models? Is this rate cut in the room with us right now? I understood like 2 sentences out of everything that you write. Just tell me calls or puts. Whoop-de-doo. But what does it all mean, Basil? This is your daily dose of 2008 financial crisis. The same post we saw in September 2020, then 2021, then 2022 and now 2023. Next year is gonna my turn. Wait, you guys are acting like this is not common knowledge. If commercial real estate is practically in hospice, why do so many investors in so many cities continue to build empty buildings? Who do they think are going to occupy these buildings and lease them for 10 years? Same with the new housing market. Are new homes in many cities actually selling that well? Are investors buying them or is it homeowners themselves? I'm hard. Okay, now I'm confused. You people were saying that recession happens 6-12 months after the yield curve inverted. Based on the past, that is why there were so many recession calls last year. Since the yield was inverted for so long. Now you say number. Actually, recession happens 6 months after the yield curve uninverts. So why everyone here in the news channels were not screaming buy last year? They could simple say buy now like there is no tomorrow and start selling when yield curve uninverts, because that's when recession happens. If it was so easy to predict the future, everyone would be a millionaire. Utilities drilling today. Money moving to the 10-year. Banks and any institutions that bought bonds are underwater with losses. Banks that did so are fucked. I forgot a glacial meltup is considered volatile within the bond market. Real pain within commercial real estate starts at 5.5. Ain't gonna do shit about fuck until the 10-year is at 6.5 a la 2000. Won't the housing market just try to ride out the storm? Keep calm and buy SPY before the crash. God, if I read one more Rainbow Bear post trying to time the market crash, I swear I'm going to unsubscribe. Soft landing. Nothing big will happen. Another day, another dollar. Ladies and gentlemen, I may not have a brain, but I have an idea. That 10 years bond prices are going down. A lot of words to say JPOW is super serial. As long as you keep predicting it, one of these days you morons will be right. I trust toilet bowl water in Mexico more than any central bank talking head. I'll just keep DCA-vu like a good little regard. You have your eye on any region in the country you think will fall first with respect to the local, regional banks or real estate markets. Calls on nay rocket upward trend money bag. So basically there is a big stock market crash coming? Pull out all your money now? Buy your bonds, you boomer. 5 is peanuts. This is just a reason for stocks to outperform bonds by even more. But the guy at the gas station told me that his brother's friend's uncle told him the housing market can't crash this time. Fuck, you got me hyped up. The truth has been spoken. What does it mean? Who let you on here? Let me tell you something, son. I've been trading stocks when you were running around calling for your mommy after getting busted for smoking crack. There is no soft landing and you have my permission to short the SPY and short Tesla. That's all you need to know. MF. Middle finger, light skin tone. Rental properties return much more than 3.5 and much more than any treasury, not including price appreciation or leverage. 3.5 may have been true in the past, but not now. Facts are wrong, conclusion may be wrong. I've become immune to anything that's not 50 movement in a day. I'll buy the dip when it bottoms out. Fuck off with your lame ass no leverage 10Y bonds.